Well, welcome. Yeah. Good. All right. So welcome everybody to the next installment of the Miami Accounting webinar series. Today we have Greg Miller from Michigan. Just a quick note before we get started. There will be a webinar next Friday. We're just awaiting the confirmation from the speaker. So we'll update the website early next week, but I'll probably send an email around to everyone as well, just sort of letting them know what's what. But yeah, we will definitely have something next Friday. And again, just to remind everyone today, rules of engagement, Greg's going to present for about 25 minutes or so. Just type in your questions or let us know you have a question in the chat down the bottom. And yeah, then we'll call on you guys during the Q&A session. And if we could ask everyone to mute their microphones during the presentation, that would also be much appreciated. All right, so let me stop sharing, Greg, and I'll throw it over to you. You also might want to unmute, Greg.
Yeah, I was going to share my screen first, but people keep sending me chats and that blocks my share screen. So thanks, Manuel, and the rest of the faculty for inviting me and giving me a chance to get some feedback on this work. It's a paper that Nyanya and I started. Actually, she started as her second year paper, and it's been kicking around for a while. And I'm going to get into, every time that I get into it, I really love the setting, but there's some issues with it as well. And those keep having me put it on the back burner. It's a lot of fun to work with Nyanya, so I want to keep pushing it, and I do like the setting. So what I'm hoping to get out of this is some sense of how much people can live with the issues, which I will point out to you. So I'm going to start. It's kind of odd to not have people stop you while you're presenting. So I try to set this up a little bit like I'm going to discuss it for myself. But I'm going to start with the setting because I think that's the core part about the paper. And I'll also point out the constraints that it faces right away, so that we all are on the level with that. So the setting is this instruction for AI. It's a new regulation that came out in Brasil in 2010, and it's related to management forecasting. One of the cool things about it is that it says anytime that you disclose a forecast, you have to disclose the underlying assumptions. Why do you have this forecast? Why do you think that it's going to work out the way that it is, and also whether this is something management can control or not. So for example, if you were an oil company and you said, here's what we expect earnings to be, you might say, but that's dependent on the price of oil and we can't control the price of oil. That's something beyond management's control. It's also dependent on cost and we can control cost somewhat. Then it has a couple of other criteria, and two that kind of go together are each quarter, as you report results, you have to go back and say, are we still on expectations with this, and explain any difference if you seem to be off track with it. And then you also have to give a 3-year history of your forecast in your regular filing each time that you file, that explains what the variance was and why, and if there's something that's still outstanding. So you know, for example, you gave a 2-year forecast. You need to say, do you think that you're going to continue that way? Or if there's any change to it, you have to let people know. Now, it's maybe easier to kind of think of these if we toss out their way of saying it. As an academic, we would think of this as contemporaneous explanations of forecast are required. There's been some research on managers explaining this, but they've not been required generally. So why do I think this forecast is going to work out this way? And then also there's going to have to be ex post analysis and explanation of any errors that occur. So in hearing about this, you know, all sorts of interesting questions popped up. And actually, I first heard about this. I was teaching exec ed to a group of IR and C-level executives about financial communications. And some of the Brazilians in there, I was saying, well, here would be some best practices you could voluntarily do. And some of the Brazilians said, oh, we have a law that says we have to do that. Now, I went to Nyanya, and it turned out that they had their law all wrong. And so it did some of the things that they said that it was supposed to do, but she knew a lot more about it than they did. And she started digging into it and did her second year paper on it. She was already looking at it at that point. And then when she finished up the second year paper, I jumped on. But if you're interested in forecasting at all, when you start hearing, well, managers have to explain and say whether they can control it, and then they're going to have to explain to you if they made an error, why that error occurred, and whose fault was it, there's just these great questions that jump to mind. The first one being, once they have to do all these sort of things, are the managers going to change the way that they forecast? They could change the type of forecast they give, point versus range. They could change horizon. They could just give up on forecasting entirely. And we have prior literature on that sort of stuff. I should say, for all of these interesting questions, we can motivate them through empirical economic literature, through analytical economic literature, or psychology literature. They all get you to the same place. And if you've read the paper, you can see that in the middle there, I'll say we ramble, mostly it's I ramble, because Nyanya had it nice and clean, and then I kept adding different things. And then when I read through it, I had just taken us off in different directions. But the thing is, you get to these predictions, no matter which literature you want to come into it through, you get to these being the interesting questions. So first, are the managers going to change what they're doing as far as the forecasting characteristics? Then second, will they become more accurate? One way to think of this is, because they have to talk more when they do it, they might be more thoughtful up front. They also may be more thoughtful up front because they know they're going to have to ex post explain it, so that they're going to be carefuler to not end up in that situation. There's also explicit bias. In the past, they might think, well, I can put this forecast out there and then not go back to it in the future, or try to avoid being held accountable for it. But now they know they're going to have to explain it. So any sort of explicit bias they would have had, there's going to be this settling up that they're going to have to deal with. And then directly following from that, if in fact this changes it so that managers are more careful and more accurate, will the market respond to this and treat forecasts as more credible? Part of that is because of the ex post costs to the managers misleading them. If they think that's gone up, then managers are less likely to do it. Part of it, though, also may be because with the extra details they're providing, the market can decide, how much do we believe this? Does this model make sense to us? Can we work it through our own model? And if they're able to do that and work it through their own model, then they can respond to it a little more. So these are the three kind of big picture questions that we have. Now, like all forecasting literature, it faces constraints, and I'm going to walk you through those so that you don't have to ask me about them. You're welcome to ask me about them at the end, and we can talk about them more too. But there's kind of these classical constraints when you're doing forecasting literature or the regulation literature. And before we started, I was looking through to see who was here, and a whole bunch of you have done this stuff, so you're familiar with these sorts of things, but I'll be explicit about them. One is that forecasting self-selection. So anytime you present a forecasting model, people say, well, there was self-selection to begin with. And now that this regulation changed, it may just change the self-selection. And what you're really picking up is changes in self-selection instead of the impact of the regulation. So what we're going to do is focus our sample primarily on those who forecast both in our pre and our post period. Sure, they self-selected into that, but when we're looking at the impact of the regulation, we're going to see how it impacted that group. We will look at people who stop or start. So we'll give you some stuff on the full sample of anybody who forecasted, but most of our focus is going to be on firms that continue to forecast throughout the period to try to level this out. Related to that, the regulation happened all at one time. And anytime that we have something that's in a calendar time, we end up with this issue that, well, what about all the other confounding variables? Now, the nice thing here is that before this became a rule in 2010, around 2008, a capital markets group came out and said, we think people should voluntarily do these things. So we have early adopters who voluntarily adopted this in 2008, and we can look at those adopters and compare them to the people who do it at the mandatory time. We're also going to compare it to other Latin American countries. So to the extent there's a shock, that impacted kind of the countries around them and that share have an integrated economy. We can try to use that. They didn't have this rule change. So, the typical ways of trying to staggered adoptions and other unimpacted countries. What about managers manipulating? Every time we present this, people say, well, now that you've increased the cost on this, managers will just manipulate to try to meet the forecast instead, which obviously is a constraint in this setting. One thing that we'd like to point out, though, is that this is going to be harder for them to do now because they've ex ante committed to their assumptions of how they're going to get there. So in the past, if you just said, I'm going to have net income of 10, and you could pull any lever to manipulate to get there, you had a lot more freedom. Now you're telling them, here's our assumptions on why it's going to be 10. So your manipulation would have to match those assumptions, or you'd have to ex ante explain it anyway. But also, we'll just look at some earnings management issues as well, or earnings management measures as well later in the paper. And then, the problem we all run into when we're doing stuff around this time, you had the 2008 meltdown. So isn't this a problem for your pre-period? We did collect a little extra, go further back than we normally would, so that we've got stuff outside of 2010. We also, though, will point out, because we've got the staggered adoption and the other Latin American, et cetera, we do have some things that are controlling for contemporaneous shocks like this. Okay, now here's a shock that's not the traditional one. And this is the thing where I was saying, I every time I get into the paper, I love it. I love what we've done. But then I hit this and I start to worry, because Brazil is just a small market. There's no way around that. Through our entire sample period, there's 578 firms that are trading with shares on the market. When you cut to the ones who forecast during our sample period, there's only 83. And that includes the stoppers and starters. And remember, I told you on the last slide, we're going to focus mostly on people who did it before and after. So we only have 37 firms then. 665 forecasts, 661 where we can come out with good data. If I was going to try to spin this in a positive way, it's a really small sample, which allowed us to hand collect stuff so we don't lose firms the way you normally would. It really is representative of the people who do forecast in Brazil. But the problem is it's 37 firms. And you're going to see in some places we get statistical results, and I feel like we can do things carefully. And then I say, okay, well, it was a small sample, but it works. But I'm going to point out a few other places where I suspect with a bigger sample, when you look at the magnitude of differences, it feels like there should be something there. And so it's really hard to say, is it sample size, or is this a real phenomena? And so a big part of what I'm struggling with, and Nayanya and I have talked about this a lot and just decided to be straight with it in the presentation. We're a field that doesn't like small samples, and getting a sense of whether people can live with this, what would help people live with it more, et cetera, because we think there's such cool things here that we could share would be really helpful. Okay, let me give you a quick example of what this looks like so you can get a sense of it. I picked Tim. Or I should say Nayanya picked Tim, but I'm going to pretend that we did it for this presentation, even though it's in the paper, because it's a company that's actually heavily owned by an Italian company, but then the rest of it trades free on the Brazilian market. So it kind of matches for Brasil. But you can see in 2007, they put out their forecast with almost no explanation. If you look down in the very corner here, you can see a little bit of explanation of what they're doing. But for the most part, they just said, here's the numbers that we expected. When we get to 2011, where they're given their forecast for their 2011 fiscal year, you can see it became a press release. And they lay out, here's the things we're forecasting at the very top. Then they give you the numbers. They tell you, look, we're going to do this annually, so that you're getting some sense of a commitment of what they're going to do. And then you can see all these words. Here's 5 different things that are going to impact our forecast. Partially, management can impact these things. Partially, they can't. And that's just to talk about revenue. They also forecasted EBITDA, and you have to go to the next page to see, they're going to lay out, well, we think there's going to be growth through increased revenue and some internal efficiencies. Those are personnel efficiencies, default rates and network costs, et cetera. They point out we can partially impact these, but we can't control our revenue growth entirely. They do the same thing with CapEx. Then we get to that. So all of that was explaining their current assumptions. And then you can see down here the table where they say, well, last time we forecasted growth of 5%, the actual was 6.10%. Here's the differences on why that occurred, so that we see the ex post explanations. Now, because this is just the second year of the rule, we're not seeing all 3 years, but they'd have to keep that history out there as they move forward. So that gives you some sense of how things have changed and what they're doing. Okay, so what do we find? Well, starting with whether the forecasting characteristics change, there's a ton in the paper, and I'm not going to cover all of it. But the first thing that we look at is number of forecasts, and you can see here that the number of forecasts decline. And it does it within our continuing sample. So remember, these are the firms that do continue to sample or to forecast, but they do less of it. It also occurs within the sample of all forecasters. So we do see some curtailment. To us, the more interesting thing is you also see they used to do a lot of long-term, more than a year forecasting, and that has really dramatically declined. And they've shifted more to annual or even shorter forecasting, which was not typical for them, for Brazilian firms. Brazilian firms used to focus much more heavily on longer-term forecasting. So we've seen a shift in horizon for sure. We also see that they shift away from point estimates to range estimates and mins or maxes. So they're becoming less precise, shorter horizon, less precise. And then also there's fewer good news forecasts now. Most of the play isn't an increased bad news forecast, but instead they start a lot more confirming forecast. And this isn't just the, hey, we have no change. This is a literal forecast where they come out and say, as we're going through this process, we're going to confirm that number. So again, some shifts in what's going on there. And then we move to the textual part. As you saw in the example, they start doing these more like a press release. And you can see there's a lot more words being used now, which makes sense where they're giving more explanations, etc. The number of numbers in the disclosures go up as well. One thing we found really interesting is that if you look at the within firm Lexel, what we're seeing is, you could argue these are starting to become boilerplate in the sense that each time that they give one of these announcements, a lot of the words are the same. So that's increased dramatically. Although across firms, it's gone up statistically, it really hasn't gone up that much. And then, we see that the amount that they say is of the assumptions that are outside of their control has stayed relatively consistent. But when they give the explanations later, a lot more of those explanations are, well, this was something outside of our control. And this kind of holds across all the different subsamples. So overall, we've seen some changes in the way they forecast. What I think is more interesting is whether the accuracy changes and the financial market's response to it. This is kind of more typical when we do the forecasting stuff, but we wanted to establish the base of the changes in how they forecast as well. So does accuracy change? Now, remember, we were arguing, well, because you're going to have to explain up front what you're expecting, and ex post, you're going to be held accountable for it, we would expect that managers may become more accurate. One way to look at it is to use a picture. So period 0 is before the rule went into place, and period 1 is after. And at first glance, the first time that Nyanya showed me this picture, I said, not much happened. But actually, if you look a little closer, you see the spike of people being right on goes up quite a bit. And kind of the interesting thing is, before you'd see this tail here, and it's been cleaned up. So what's happened is that forecasts are getting much tighter around actual, with a spike, and then we're losing the tail here. Another way to look at it graphically, and I'll show you the tables in a moment as well. But another way to look at it graphically is that we just did a accuracy coefficient. Positive actually means you're becoming more accurate because we multiply the accuracy by a -1. And so this is forecast versus actual. And what we show is that in the periods after, so 2010 on, when they had to start explaining this stuff, accuracy goes up within the sample. And so this seems to show that there's an impact of accuracy increasing. Now, if you're old school and you prefer to look at tables, I've noticed that graphical seems to be the way as more and more journals go online that we're presenting things. But I have to admit, when I was putting together this presentation, I kept thinking, boy, I just want to show them the numbers. So if we take the full sample of continuers, so this is all of the forecasts done by the people who forecast both before and after the rules. We can see that the coefficient on the post dummy variable, so picking up what's going on incrementally in the period after, is positive and significant, indicating that as a whole, we are seeing a result there where they're becoming more accurate. And then when you break it down into positive errors and negative errors, so did you beat expectations or miss expectations, you can see that it's significant for both. I'm just going to move the, I've been watching Emmanuel's face here, but I'm going to have to hide that for a minute so that I can see the whole slide. But we can see it's positive and significant for both, meaning that both positive and negative errors became more accurate or smaller in the period afterwards. Now, the thing is, when I look at this, I see the magnitude of it and I think, wow, negative seems like it had a lot bigger impact, which also matches that picture we saw where it was really cleaning up and tightening up that big negative tail. But this is where that small sample size kicks in on us. You can see that it's not statistically significant. And now we're in those 37 firms and the 661 forecasts, and we've got to break them down into positive versus negative errors. And our standard errors just get too big. And so, we can say it impacted both groups. We can't say that it impacted the negative more than the positive because we can't get the statistics to work out. And this is something where, the hesitancy about sample size really matters. Now, another way that we cut this out is we started to worry, well, this rule is effectively really encouraging people to revise their forecast more frequently than they had been doing before the rule. And so we broke it into the first forecast for the period and then revisions of that forecast. And again, you can see whether we're talking about the initial forecast or a revision of the forecast, it's more accurate in both cases. Now, again, you look at the magnitude and think that it looks like it had more of an impact on the first forecast. And we're back to this small sample size where we just don't have a lot of significance. And so that part's frustrating. Now, I talked to you about all of those research confounds that we might run into. So I'll just run you through those robustness tests quickly. When we compare the mandatory companies, those are the ones who are just putting this in place now at the regulation time, to the voluntary adopters, all of the result is coming in the mandatory companies. The voluntary adopters are not having a change. It's bringing the mandatory companies to the level the voluntary adopters were already at with accuracy. This indicates that it was the regulation that had the impact, not the shift in economics, because if there's a shift in economics, it should have impacted both of these groups. Similarly, if we compare Brazil to the rest of Latin America, we get strong results in Brazil, but there's no result at all in the rest of Latin America. It's completely flat. So to the extent that those economies are correlated, we're not seeing it in an economy where there was no rule change, and we are seeing it in an economy where there was a rule change. The final cut here is that we compare ADR firms to non-ADR firms, and we actually get two things out of this, we think. The first goes back to what those first two were showing us, that this isn't an economy-wide shift, because the ADR firms tend to have more business outside of Brazil as well. So they're more integrated with the international market, yet we see the result for them as well. So it's not just something that happened within Brazil. The second thing is that the ADR firms face more oversight. One of the things people have said is, well, maybe the Brazilian market just doesn't have a lot of non-regulatory oversight. And so now they're finally getting oversight because there's a regulatory issue. But the ADR firms would be facing the capital markets oversight in the US, the legal setting there, et cetera. So we think that gains us that part as well. So now for this to be something that's due to a time period specific shock, it would have to be something that impacted Brazil, but not the rest of Latin America, impacted mandatory company or filers within Brazil, but not voluntary adopters, and the ADR firms that do a lot of business outside of Brazil are impacted, which conflicts with the idea that the Latin American countries weren't impacted. Okay, moving on to credibility, which is our last set of findings here. And I'm almost running out of time. This went a lot faster when I was just doing it in my head. Does credibility change? So here I'll show you the whole table so you can see all the control variables, etc. But the short answer is yes, credibility goes up. You can see that per unit of market news in the post period, there's a positive coefficient for the full sample. It's there for the first forecast and for the revisions. We don't get significance again, although the magnitude of these, again, in a bigger sample, I would love to see, are the revisions actually statistically bigger than the first forecast? But what this is telling us is that the market, that's Emmanuel, very smooth of me. The market is responding to this in a positive way, in the sense that they now believe managers more per unit of news. And so we're calling this more credible, but you can also just think of it as a bigger market response. One of the things that I did, one of the reasons I want to show the whole table here is to point out these ends. Market information is noisy to begin with. And when you're running regressions where, we did this, the first forecast and the revisions, we stacked into a seemingly unrelated regression to try to make some use of the shared information across the two samples. But still, we've got a group with 109 observations. That's that small sample effect we were talking about. Now, on top of cars, we looked at abnormal volume, which is another way of saying, is the market responding? When you look in the full sample, we do see abnormal volume go up. Here, it's entirely due to the first forecast, though. And in fact, we get an insignificant result in revisions. So even though the market price moved, we don't see any abnormal volume around the revisions, and we do get a statistical difference there. Volume data is harder data to get, so we have even smaller samples here. And this, again, is something that I want to make sure people are aware of. So we do see a volume result here as well. So we get all done, and kind of with the set of results we've shown you, and we're showing you that there's been changes in the way people forecast, and they're more accurate, and the market treats it as more credible. Every time that we show all this to people, they come back and say to us, well, I think the managers maybe are just manipulating to it. And so we decided to do a test of various earnings management measures. Now, I'm never sure which earnings management measure is the right one. So we grabbed a paper, one of Mary Barth's papers, that had multiple earnings management measures in there, and we ran them. Ex ante, I was really worried about this because we're back to this, we don't have a lot of observations, 207 in the pre-period, 158 in the post-period as far as firms. And these are noisy measures. And so a non-result, when you've got a noisy measure in a small sample, wouldn't have been all that reassuring, although it would have been better than a result. But instead, what we find is 3 of the 5 are significant on earnings management, but in the opposite direction of earnings management. So even though these seem to be low power tests, 3 of our 5 measures say, if anything, earnings management went down during this period. And the other 2 are insignificant. This reassures us that our results aren't being driven by managers just manipulating like crazy. Now that I told you I was going to make that number, I'm going to manipulate and make sure that I make that number. So when we put all of this together, we see that managers reduce their forecasting slightly. They switch to less precise forecasts, and they reduce the horizons over which they forecasted. This probably was not what was intended with this rule. If you think of the forecasting literature, generally people would say less precise, shorter horizons, and less forecasting are all things we don't want to have happen. So there's a little bit of an unintended consequence there. Now, of the forecasts that they did give, though, accuracy actually increased, and we saw that it was a pretty substantial increase in accuracy and across a broad range of forecasting. And then the market response increased as well. particularly in the returns response, but there's some evidence in abnormal volume as well, suggesting that the market views these as having greater credibility. We did a whole bunch of robustness tests in here. You know, I know it's a small sample, and it's a small sample that has all of these kind of traditional research confounds of a regulation happening at one time, and you know, the 2008 market meltdown and all that sort of stuff. But the results were very robust to showing us it's not a time-driven shift where something happened in the economy in Brazil, nor is it due to earnings management. So despite the small sample, we feel like we can feel pretty confident that what we say is going on in this sample is going on. Now, I feel like I've done an excellent job, so I can't imagine there's any questions, but Emmanuel said you may have some anyway. And so I will turn it over to them, and they tell me they're going to manage me knowing how to manage these questions. Let me see if I can stop sharing my screen.
You can keep it shared if you want, in case people want to go back to stuff.
Sure.
All right, so first question, I think we have Jen, Sue.
Aloha, everyone. First, I would like to give a big shout out to the Miami accounting faculty. This has been the entertainment for me during the age of coronaviruses. Yeah. So secondly, my question, aloha, Greg. Yeah. Secondly, my question is, will managerial characteristics play a role? Let's say if I'm a kind of like a brand new manager, I want to establish credibility in the market. Maybe I'll do this kind of things. If I'm kind of a manager close to retirement, I don't care what's going on. So I probably will not issue this kind of forecast. So that's my first one. My second one is, will financing need play a role? Let's say if my firm wants to have access to external financing, maybe I do this kind of forecast. If I do not want to access the external financial markets, I don't care. I do not do this kind of behavior. So these are my two questions.
So let me start. Actually, let me start by saying Nyanya is going to be taking questions. So to the extent that I'm writing, it's just so that I can remember what you asked to answer. But she is writing them down. Both of those are great questions. I'm going to start with the financing question. It's interesting that you asked that. So part of the reason that this rule was put in place was to make it easier for firms to do shelf registrations and go out and get add-on financing. There's actually a rule in Brazil, and everything I know about Brazil is actually from Nyanya, so hopefully I won't butcher this. But there's a rule in Brazil that says when you do an offering, you do have to forecast. They require it. There's other countries that require that too. And so part of the impetus for this was, let's have people getting forecasting out there, have a strategy in place, et cetera. Brazil's kind of an interesting market because unlike the US, there's not a lot of diversity in share ownership. It's a historical fact of the way that it rolled out that there tend to be very large. Tim, for example, that I showed you, is 65% owned by one other company. And so it is a different kind of a financing market. I would say that with our ADR firms, they tend to be firms that have cross-listed partially just for visibility reasons and partially for liquidity and financing. And we see it across both of those samples. That's the closest we have right now on the financing. We could look and see. I just don't know what the financing demands were within the sample. This may be the small sample issue, that there just may not be enough variety there. Same thing with the manager characteristics. There's a literature that seems to indicate there are some points in a manager's career. I just don't know how many of the firms we have where it's very early or very late, because I'm not sure what to do with the managers in the middle. But it's a small enough sample that we could look into that. Yeah.
Thank you.
Mm-hmm.
All right, next we had a question from Anish.
Hello, everyone. So my question is essentially, so I saw the disclosures and they're pretty detailed. So I was just wondering, how strong is the regulation to actually hold managers to task if they miss on, some of the disclosures, or if later they found that these disclosures are not true, because by providing such detailed disclosures, you probably are increasing credibility in the market, which you can see from the data. So, if you had something like that, saying that the government is really serious on people, making false disclosures or something like that, that would be really helpful.
So you're thinking if we could find some anecdotes of where people violated these?
Yes, kind of, in the sense that if you are saying, the managers could provide very detailed disclosures and then manage earnings to meet those disclosures. If they thought that, no one's going to be behind us, taking us to task, or if the market was so small or did not have depth that there is no choice but to trade in us only. So providing an anecdotal, examples of those would probably lesser the concerns of, say, earnings management. People would know that there are consequences if they did not meet those disclosures, or if they do not stay true to those disclosures. So that's
okay.
Kind of my suggestion.
Yeah, so we can look into that. I think, the fact that we find that if anything, earnings management went down makes me a little less concerned about that. And then, again, part of the reason we looked at the ADR firms is they are subject to more scrutiny by other markets and potentially to other legal environments. But the fact of the matter is that in Brazil, there's a lot less litigation related to things like earnings management or false statements. And so I guess the question is the regulatory teeth. I don't know whether regulators have come back to firms that they were unhappy with what they have done. We'll have to look into that.
Yes, thank you.
Mm-hmm.
Next, actually, we have one of our PhD students. Is that you?
Yes. Hi, Greg. Thank you for your presentation. So my question is regarding the figure 1 you show us. So in figure 1, you show us the histogram of the management forecast accuracy before and after the regulation. And you also mentioned that there are a bunch of extreme forecast error before the regulation, and those errors just disappear after the regulation. So my question is, have you considered the possibility that your result could be driven by those extreme cases? So in other words, do you think whether the regulation can impact all the firms or just impact some typical firms like those firms have extreme higher forecast errors?
Sure. Part of the issue is, again, small sample, there's only so much we can do to play it out. I don't think that it's just the extremes. I mean, certainly what the picture is showing us is it's pulling those extremes in, but remember, those are negative. We're not seeing the extremes on the positive side. And when we broke the sample down into positive and negative, we see a result both ways. So even in the positive where we don't see those extreme observations, we are seeing an impact. The question on the negative side of it is that much bigger coefficient because of a few extreme observations? And that's why we're not getting a statistical difference. So Nayanya and I have talked about this. Maybe in a really, really big sample, we still wouldn't get a statistical difference because it's the impact of those outliers that makes the coefficient look so big, but most of the mass is more of a symmetrical impact. Does that make sense?
Yes, yes, thank you.
Christina?
Yeah, hi, Greg. Thank you so much for your presentation. And it's a very cool setting, so I truly enjoyed reading your paper. I actually have a couple of questions, if you don't mind.
Okay.
So the first one is more like you talk about that managers are now providing all this information. Basically, they are making better forecasts, better disclosure of those forecasts, and so on. So I'm wondering, how did that impact analyst forecast accuracy? As you may argue that now analysts also get a better sense of where the company is going. So one of the consequences, in addition to immediate market reactions to the guidance, you can also explore, which would add a lot to your paper, right? Whether there have been some unintended consequences on analyst forecast accuracy.
Okay, can I respond to that? We'll do yours one at a time so that I don't have to keep my old brain straight on the questions. I think that would be an interesting question. The fact of the matter is that there's not a lot of analyst coverage in Brazil.
Okay.
And so even in our expectation test, we end up using last year's instead of the analyst stuff because IBIS just doesn't have that much analyst coverage.
Okay.
So I'd have to go back and see, whether we can get at least some insight into it. But we thought about it at one point. We looked at it and said, there's so few analysts that we weren't sure that we could get anything out of it. I think at one point we tried looking at the ADR firms who have more coverage.
Okay.
And just there was so little there that we were afraid. The paper already has a bunch of factoids, and part of the struggle is figuring out what are the most interesting pieces to hit with.
Okay. And my second question is more general, as I know nothing about Brazilian firms and their disclosure requirements in general. So my question is, do they disclose any of the risk factors, forward-looking statements somewhere in their like normal regulatory filings that they do? Or, because a couple of examples, and that's basically what happens when you show people examples, right? People fixate on them. In a couple of the examples that you're showing, they're saying that, okay, this is not our fault because we were subject to this risk. So my question is like, were they disclosing this risk elsewhere and now they are just pointing this information, they are highlighting this information in this guidance press release?
So I don't know the answer to that explicitly because the sorts of risks they're talking about to some degree are things like we don't fully control revenue growth. Or the reason I brought up the oil company is Petrobras. I had looked at some of the stuff, and I know Petrobras talks about geopolitical risk, etc. But then they say, and it turns out all of the oil majors actually say, we don't control oil price. And so that's a risk, but not the same sort of risk that we think of in these things. But it's something we can look into, whether these were somewhere else before. I think even if they were, the interesting part to me is now when they give you the forecast, they have to say this very explicitly is part of what's going on, right? Now, we'll see in next year's. I just saw an article in the US saying that a bunch of managers are doing like EBITDA, and you put a C in there somehow because they're throwing out coronavirus impact as well. We'll see. Maybe a bunch of the managers will say, well, we didn't anticipate coronavirus, and obviously it's having a big impact globally and in Brazil.
So there are no conference calls, nothing like that, like we have in the United States here.
There are conference calls that we could look at, and I think one of the things you could say if you looked at like the example I gave you, you're right. People do anchor on an example, but the whole point of giving it to you is so we have a frame we can talk about, right? And so certainly one of the concerns is you put a forecast like that out, and then we know on conference calls people ask questions like, can you give me more detail on that? The difference there though is that you're forcing the analyst to pull it out of you, and you're not committing to it in writing. So this rule went in place saying, when you give me a forecast, you have to commit to giving me some sort of explanation of assumptions, and you have to commit to commenting on that later. There's a paper that we don't cite in here that I don't think we do, that as we're talking, we should bring up, which is a Strand and Walther paper on strategic disclosure, where it's a really cool paper. They look at managers who have gains and losses, and they basically show that if your earnings are down this year because of a loss, you point it out, but you don't on the flip side. So when you have a gain, you don't point the gain out in the year that you have it. But then next year, when your earnings are lower because you don't have the gain, relatively speaking, you point out, but last year we had a gain, and you do the flip with a loss. This rule would block you from being able to do something like that, even if it was other places.
Okay. And if you don't mind, I will ask my last question. How do you compare accuracy? How do you measure accuracy of a range forecast? Because like your first finding, you have more range forecasts in the post period, but more point forecasts in the pre. And I'm wondering how can you compare these accuracies?
So I'm going to start with the answer that I told Emmanuel and Nyanya and all my students. You can never give, which is we just did what the field does,
Yeah.
which is midpoint. But we actually have a footnote in there that says we can use bottom or top of
Yeah.
the range. Well, so we've tried it a couple different ways to make sure that it's not the range alone doing it. Also, I didn't put all the control variables we have in there, but we controlled for form as well. So to the extent that it was completely a form shift, to the extent that you believe that that variable would pick it up. And,
Right.
you know, I'm always a little shaky because of all the cross correlations that go on with those variables. But we've both tried to control for it. We've tried it in a couple different variations, and the results are robust to it.
Okay, thank you so much.
Sure.
No worries. I think we have Yini as well.
Hi, Greg. Thank you very much for a nice presentation. I really enjoyed it. And I think my question is sort of related to Christina's first one. While you were talking about this, I was just thinking, do you expect the role of financial analyst to be probably different in the Brazilian setting from that in the United States? I think maybe it would be helpful to check the percentage of family-owned businesses and kind of related to why there is such a few analysts coverage in that setting.
Okay, we can certainly do that. I'm going to go out on a limb here, and so Nyanya can disavow everything that I'm about to say, but for several years, I had a lot of Brazilians and some exec ed that I did that was financial communication related. And sell-side analysts were not as common for them, partially because of the way that their market works. So remember when we say there's not analysts, we're talking about sell-side analysts, and they don't have the big retail market. They've got buy-side analysts who are working with the internal institutions. So I should be a little careful and say, when I say there's not analysts in that market, it's that market, because of the lack of retail investors, doesn't have the sell-side coverage. But there certainly are buy-side analysts. I mean, I've trained, I've had some of them in my classes who had been buy-side analysts, and I've had some of them in my classes who, after graduating, went back and took buy-side positions there that are doing the same things. So we can look at family firms. A lot of the firms aren't as much family firms as they are owned by other corporations as well. There's cross holdings, etc. But it's just a market difference. It's something we can dig into more. The paper's kind of long right now, and there is some stuff in there on the Brazilian capital markets because we feel like it's important for a reader to understand that.
Right.
But it doesn't include stuff on analyst. And given the interest, maybe we need to go and say, well, relatively speaking, some of the stuff that we're talking about might not be as important as getting some more in there on the analyst role.
Okay, thank you very much.
Yeah, thank you.
All right, Fabrizio can wait. So we'll go to Dawn.
Hey, Greg.
Hey, Dawn.
I think you answered one of my questions when you were talking to Christina, just about controlling for the nature of the types of forecasts, like shorter horizon forecasts will be more accurate. And since they changed to shorter horizon, I assume you controlled for all of that, right?
Yeah.
Okay. But my other question is, you sort of like, what was the Brazilian regulatory authorities' reason for making this change? Like, what were they hoping to accomplish? And then also, like, so we find that the stock market finds it more credible. And do you have any sense about why that it's more credible? Is it the disclosure about what is controllable, what is not? I mean, I would assume most people would know oil prices are not controllable. So that couldn't have been new, right? I mean, or is it the expo settling up? Like, what was your sense of why they viewed it as more credible?
Okay, so let me take your second question first, and then I'll make you remind me of your first question when we're done talking about it. But the second question, we have a table in there, and in the interest of time, I decided not to put it in there, but there are firms that voluntarily adopted either the explanations or the ex post, so the assumption explanation at the time or the ex post, but not both. And so we thought, well, we can try to tease out which one is it that matters. It turns out that we're seeing the same impact. So neither one seems to matter. in the sense that if you only did one of them, you're still less accurate and less of a market response. You need to have both of them in there. Now, the caveat to that is the firms that voluntarily started doing both remain more accurate afterwards anyway. So the other firms get closer to them in level, but they don't get exactly the same. So they were just better firms as well. Yeah, it doesn't seem to be one or the other. We were hoping that when we played it out, we could say, this is the really important part.
Yeah.
But I guess when I think it through, like the stuff that, when I put together all of the forecasting literature and tried to give recommendations in EE, or I have a class I do on financial communication, and we talk about how should you forecast, what should you do? Really, people want both, right? When you put it out there, if you explain it, they can assess, do they believe it or not? And then they want you to come back and help them understand from both an accountability standpoint, but also to build a better model going forward. If I can understand why an error happened, this is you spent a lot of time around Bob Kaplan too. Bob always used to tell me it's like after an airplane crash, right? You want to understand why it happened so that we can build better models going forward. And so there's value to both pieces, and we just weren't able to tease one or the other out. And then your first question was, why did they put this in place?
Yeah, what were they hoping to accomplish?
Yeah, so on the surface, the thing that they said is we want people to be able to go to the market more, and so we want these shelf registrations where this information is already out there and the market can better understand them. And Nayanya talked with some people who were involved in putting in, and that was what they really pushed. There is some stuff just in general that they wanted to give a better understanding of what's going on in firms and how they operate. So it's hard because they didn't. It's kind of like Reg FD, and I know you've done not only some of the work we co-authored, but other work on Reg FD. There's kind of the explicit reason the regulators put it out there. And then there's all these other things that different entities thought was going to happen, right? And so the first entity that recommended this, where it was non-binding, was saying this is going to lead to better information in general, a better understanding of firms. Then when the regulators picked it up, they said, well, this will really help with shelf registrations. But it's hard to nail down the one piece.
Okay. Anyway, interesting paper.
Thank you.
All right, Fabrizio, go for it.
Hey, Greg, thanks for the presentation. As you might recall, I saw this paper in an earlier version. I thought that it was very interesting back then, and I still think that way. The setting is very interesting. So I'm going to ask you actually to go a little bit beyond the paper, just since it's a webinar and we're having fun, and tell us, what would you do if tomorrow you get a phone call from the SEC saying that, we've seen your work on disclosures, on forecasts, on investor relations, including this paper. On Brazil, what would you tell us to do if we were considering introducing some kind of, mandatory disclosure with regard to management forecast in the US? And the answer could be also, I think nothing should be done. But I was curious just how you view the need for regulation in this area in the US markets.
So interesting question. I guess I've thought about it a lot, but more, what would I tell a company? Or if I was a big investor, and I've had some big investors call me and say, what should we be pushing companies to do? And so, that's a little separate from what should regulators do, because once we move into the regulator, there's some issues. But certainly, I encourage all companies. In fact, I have a 2009 summary of the forecasting literature at the time that I was asked to do by a think tank. That Christian Leutz actually introduced me to the think tank. At the end of that, they asked me for, recommendations. And the recommendations I made were basically what's in this rule. And it was before I knew about the rule. I think better explanations up front. I really like the idea that you commit to what your forecasting is going to be so that it doesn't seem opportunistic. I pitched to companies that one reason to have a written policy that says, what forecast am I going to do? What sort of horizons, what items, et cetera. How am I going to explain it to people? And a commitment to ex post explanation of it is to help their process as well. If you think of things like internally, when we talk about doing balanced scorecard, we say a big part of the value is clarifying the process in your own mind. So I think there's value for companies to do that to begin with. As an investor, I want to know those things because I want to know how management thinks. The value of a forecast is to learn how management's thinking about what's going on in their company. And by giving that more detail, I think we would get there. The question of should it be regulated, though, is a different issue. And so in Brazil, where there's not as strong of a capital market and there's not as strong of a litigation environment, maybe they needed the regulation because the external forces couldn't push for it as much. What worries me in the US is a lot of the external forces are saying, don't forecast at all, which seems crazy. You're telling managers, don't explain to me how you see the future of your company, make it vague instead. And here we're asking for more specificity and more rationale on why you're doing it. But if the SEC asked me, do I think it would make forecasts more useful if you had to do this? The answer would be yes. But the trade-off is there's fewer forecasts now, they're shorter term, and they're vaguer. And I don't know what the social welfare trade-off of that is when I look into the literature. Dawn, who just spoke, has a paper that shows a longer term and a shorter term forecast together seem to give better insights, etc. So did I not answer your question enough?
I think Nina, you had your hand raised. Or not? No, maybe no. Okay, well, actually, I do. So let me jump in. So a couple of things. The first question, did you have any insight into, and I guess it's kind of what Dawn was getting at too, which was what managers were sort of doing to become better at the forecast are related to the accuracy. So is it that they're actually learning, like are they putting in the effort and learning about the company more, learning about what's going on a bit more, or is it that they just had a lack of effort in sort of the pre-period and now the regulation kind of makes them?
We can't even sort out whether it's that they already knew, they just didn't mind giving you forecasts that were off before, and now they're more concerned about it because they're going to have to ex post explain it. So there's psychology literature that would say making them go through this process would make them better at it. It would reduce cognitive biases, etc. And so we can tell you there's a psychology theory that would say the process alone should make them better at it. But we can't separate out, is this simply a way to hold the managers more accountable? Or even a third option, which is, remember we saw this reduction in forecast. Maybe managers go through this process and before they were willing to put it out there when it was relatively uncertain, and now they're just being conservative about which forecasts they put out there. Which goes back to why I can't fully answer Fabrizio's question. In an ideal world, the manager would still put that forecast out there and then say, but I'm uncertain on it, and here's the assumptions that make me uncertain on it. But there may just be some self-censoring going on too. So unfortunately, because there's 3 different answers there, and we can't observe the actual process, we can't sort those out.
Yeah, I mean, when I was the reason I asked, I was thinking Nemeth's dissertation, right? Which is there's a rule change the manager actually learns. So I was thinking if you looked at, and again, it probably goes beyond the paper, but if you looked at sort of other outcomes, do they become more efficient in their corporate investments and things like that now to sort of tease out if they're...
Yeah, no, you violated an agreement I thought we had, which was to never mention Nemeth's dissertation to me. But there's Nemeth's dissertation, then there's the work that Nemeth has on forecasting too, with Hal and a couple other folks, where when more people in the industry forecast, you learn more. And so certainly if we had a larger sample here, it would be an interesting question. When you provide more information with your forecasting, can your competing firms or everybody else in your industry get better at figuring out kind of what that forecast means, what it means for them in the industry, et cetera. I don't think we have a large enough sample though. I mean, one of the beauties that Nemeth had in his dissertation was this was applied to many, many firms across the US, and he had the ability to do a lot of cross-sectional work to try to tease it out that we wouldn't be able to do here.
That's right. The other thing was kind of actually Fabrizio got into it a little bit, which was if I'm thinking about how to sort of put this in sort of a US setting or what to take away, what I wondered was, did the Brazilian sort of capital markets need this because, and I'm not sure if they have conference calls or things like that. So what I wanted to know is, one, how much do the conference calls kind of discipline managers here in the US from just sort of making crazy forecasts and things like that? And is that sort of enough such that we don't need to have a regulation that sort of puts this in writing, like they do in Brazil, for instance?
My gut is no. In fact, one of the things I find fascinating about Brazil is that they actually have much bigger investor relations departments than we do in the US. And in fact, in Brazilian companies, there's some requirements. And then for the ADRs, there's actually funding from their ADR companies to help support the IR companies too. So when I used to do the exec engineering, we would get a disproportionate number of Brazilians, and often there'd be 3, 4, 5 people from one company. So in many ways, they're more developed than we are with that kind of communication. It tends not to fully be in public as much though, because it's a smaller environment. But certainly there are a lot of people asking Brazilian managers a lot of questions. There's a difference between giving an answer, you know, like I was with Fabrizio, very vague on this call. And if afterwards you tried to nail me down and say which piece of that was really the important piece, I had enough disclaimers in there, et cetera, that you won't be able to do that, right? Versus if you forced me, you know, if you went to my written piece on, here's what I recommend, and then you came back to me and said, you recommended this, and now that's inconsistent. There's a huge difference there, in my opinion.
All right, so cognizant of the time, so we've run out now. Thanks a lot, Greg. Thanks everyone for participating. Like I said, we'll update early next week, but there will be a webinar on Friday. And if you have any other questions, please definitely feel free to email Greg or Nayana directly. And thanks again, and we'll see everyone next week. And the video recording should be available either by the end of the day or early next week, for sure. Thanks a lot.
Thank you very much.
Cheers.